Welcome to episode 36 of the Cashflow Connections podcast. Our topic for today is residential investment strategies of a self-made millionaire. Today, we're going to talk with a well-known real estate commentator, investor, and entrepreneur about a variety of topics with a focus on the residential real estate market. Going into this conversation, I really didn't know what topics I wanted to focus on because I like our guest's perspective on a variety of noteworthy subjects related to investing and the economy as a whole. And additionally, through his podcast, he has had discussions with some of the most influential people in the investment space and otherwise. So I always find it interesting to find out some of the key takeaways from all those hundreds of conversations with just incredibly successful individuals. So we did cover some major ground, and I'm sure you're going to enjoy it. So in this episode, we're going to talk about what you can tell about the volatility of a market based on the percentage of the purchase price, which is attributed to the land value. This is something that makes sense intuitively, but I think it's really important to kind of iron that out in a specified fashion. Also, we're going to talk about how our guest coaches his students how to invest conservatively and lucratively by identifying markets that have favorable risk-adjusted histories. So what I mean by that is there's a kind of a differentiation in between linear markets, cyclical markets, and a hybrid of the two. So we have a good conversation there about what to expect with certain markets and what the market's history of volatility can tell you about its future progress. We're also going to talk about how our guest leverages his network and his referral base to really put pressure on property managers, particularly residential property managers, for long-term performance. This is something that people get caught in all the time. If you invest in a residential property and the property managers only stand to gain $50 or $100 or $150 a month, it can be very challenging to make them act in their own best interest. And so, if you're able to leverage your network, you're able to do that, and they stand to gain or lose a much more significant amount of money, and they are going to usually end up acting on your behalf. So it's definitely something that a lot of investors that are listening to the podcast are going to enjoy. Now, don't forget, as always, I am looking for new and interesting guests to come on the program. In fact, we've got upcoming interview with Chris Voss, who is the author of Never Split the Difference, which I think is going to be a really fascinating conversation. I think that we are going to get into some of the ways in which we can use his strategies for real estate investment negotiation. I think it's going to be really interesting. But having said that, we're always looking for new guests. So if you have an idea of a great guest for the Cashflow Connections podcast, don't hesitate to shoot me an email at hunterthompson@cashflowconnections.com. Just make sure you put guest in the subject title so I know to open it as soon as possible. My only request is that your suggestion needs to be a major player in whatever sector they are knowledgeable about. So just shoot me an email with your suggestion and give me a brief explanation of why you think it'd be a great topic, and I will take a look. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Jason Hartman, who is the founder of Platinum Properties Investor Network. He has owned income properties in 11 states and 17 cities. He has also produced a variety of educational resources related to real estate and real estate mentorship. From very humble beginnings, Jason quickly worked his way to one of the top % of real estate realtors in the US, and quick succession earned a number of prestigious industry awards and became a young millionaire. He is also the host of one of the most popular real estate investing podcasts on iTunes, Creating Wealth with Jason Hartman. So Jason, really thank you. Thank you again for coming on. Appreciate it.
Hunter, the pleasure is all mine.
So, before we jump into some of the details, which I know we're going to get into a lot of different topics today, just given your background, but give us a little bit of understanding about how you got started into real estate. What interested you in the space in the first place?
Yeah, so I actually saw an infomercial when I was 16 years old. I grew up rather poor in Los Angeles, California, didn't like that very much. And that sparked my interest. And I got my real estate license just so I could kind of learn the trade, if you will, and understand the basics when I was 19 years old in my first year of college in Long Beach, California. And I started just selling real estate part-time and did pretty well at that. But then about 6 months into my career, I'm 20 years old now, Hunter, one of my clients, and I became interested, by the way, to invest in real estate, but I figured I'd just learn the basics by selling it. from clients and the basic industry stuff. And one of my clients came back to me about 6 months into my career at the ripe old age of 20 and said that one of the properties he purchased from me, he was an investor buying several properties. He didn't like it very much, and he asked me to sell it for him. And I said, Jim, I don't want to sell it for you. I want to buy it from you. And that was my first rental property at age 20 years old. It was a little condo in Huntington Beach, California. And I went on from there, and I stayed in the brokerage side of the business, but kept investing all along the way. Now, I eventually bought my own real estate company, grew it pretty dramatically, although it was very, very big challenge to do that. I sold it to Coldwell Banker in 2005. Many people say my timing was fantastic, and
Absolutely.
it was pretty good. And that was in Irvine, California, that company. And about a year before, in 2004, as I was negotiating the deal with Coldwell Banker, it took about a year to do the deal. It was very complicated. I started thinking about what I'm going to do next, of course, like anybody would. I thought, should I retire? I'm financially independent. I don't need to work, but retirement sounds really boring, and people who retire die early. So that doesn't sound like a good plan. I love to work. And so I thought, what should I do with my investment capital as I'm trying to figure out my the next portion of my career? And so I started getting interested in a diversification play. I'd always invested locally in Southern California and did quite well the vast majority of the time, made lots of money. But I was really more of a speculator than an investor. People that invest in cyclical markets with glorious highs and really ugly lows, Hunter, are not investors. They might call themselves investors like I did, but they're really speculators or gamblers. Investing, to me, is the process of creating value over time and getting yield from the investment, because capital gains is unreliable. Nobody can, at least nobody I've ever met, can reliably predict the capital appreciation cycles, the appreciation and depreciation cycles in the market. Very hard to predict. Everybody who says they can, think they can, they seem to do okay for a cycle or two, and then they fall on their sword. And I can share lots of stories about this. I'm sure you can too. But when you simply invest for yield, cash flow is pretty darn reliable. Nothing's perfect, but it's pretty reliable. By this point, I'm older, I'm more conservative. I don't want to go through earning all my money again. I'd like to keep it this time around. And so I start researching markets all over the country, thinking that income property is the most historically proven asset class in the world, but all real estate is local. So why not take the most historically proven asset class, but diversify geographically? And I started researching and researching, reading all the books, the Places Rated Almanac, cities ranked and rated, visiting all the websites, spending hours and hours on the US Census website, looking up building permit statistics, just really trying to gain a big understanding of really the global real estate market, but mostly the national market. And as I was doing this, I got some book research and some online research. And then I started flying to many of the different markets around the country that looked interesting. And Hunter, I just discovered that, first of all, most real estate people don't know anything about investing. Some even in commercial real estate don't know much about investing, as
Right.
odd as that may sound. But I know we all know that's true. It was very hard for me to get anyone to really help me and do it well. Everyone was kind of looking at everything as a transactional basis rather than a relationship basis. It's a very flaky, fragmented industry. And I basically, and as I was doing this in 2004, I was also visiting all the Wall Street financial services firms, Merrill Lynch, Ameriprise, Charles Schwab, et cetera, et cetera, et cetera. And I was talking to all their elite private client group people that deal with high net worth investors. And I thought it was a joke. I thought I couldn't believe it, Hunter. These people, they all say the exact same thing. They give you these pretty little pie charts, modern portfolio theory, oh, small cap, large cap, international. Give me bonds. Give me a break. Like, seriously, does anyone actually have any ideas here? And then, of course, everyone knows the famous book, A Random Walk Down Wall Street, which basically says you can't beat the efficient market, right? So just put your money in the index and you're done. And that's about
Right.
as good as you're probably going to do. So I thought, what am I doing talking to these Wall Street people? I got into this career. I got interested at age 16 because I thought it was the best investment. I made a lot of money investing in it. What am I doing? So I continued to fly and travel and visit these markets and talk to people and work with them, try to acquire properties in the markets I thought were good. I'd go to Texas, Georgia, et cetera, Indianapolis, all these different places, and Tennessee, and I just couldn't do it. It was just too difficult. So I basically created the business I'm in now to be my own first customer. And that's what I did. And there have been many discoveries along the way about how to invest properly. And I'll be glad to share those with your audience. But lest I keep rambling, you might have a question, so I'll stop.
Yeah. So just to kind of clarify, when you say the business that you're in now, can you kind of explain how that story really led to
Yeah.
your creation of that?
Yeah, absolutely. So basically, I thought, the Wall Street people make it really easy. And that's why most people just put their money with some wealth advisor who isn't wealthy, okay, and who hasn't created wealth with a method they're telling all of the rest of us to do: stocks, bonds, mutual funds, etc. Uh, but they do make it easy. Wall Street has a mediocre investment, but they have a great business model and a great sales force. When I say great, I mean great for them, not the customer. Okay. But it's great for them. It works. And I thought, why can't there be a financial services firm for real estate investors? And I couldn't find one. So I created one. And that's what I've been doing for 14 years now. And that's basically the genesis of it. Most entrepreneurs, they start a business out of their own frustration and their own need. Very common story. They think, well, I want this product or service or widget. I think other people would want it too. So I'm going to create that business. And my story is just the same as anybody else's in that way.
Interesting. And so just to clarify, I guess, what is necessarily the product that you kind of help solve that problem with? What are the vehicles in which you kind of facilitate that?
My business does three things. We teach people how to invest conservatively and effectively. We've developed some truly new ideas and philosophies about investing, which I hope we can share today. And then we provide a referral network, a network of affiliates in markets we like, from teams we like, where people can acquire properties nationwide. They can diversify. We recommend that they be in 3 to 5 markets, at least 3, but not more than 5. I made the mistake, and you alluded to, I'll just tell you in my intro, my huge mistake, one of many, is that I over diversified at first, because think about it. I lived in Newport Beach, California, where everything's very expensive at the time. And when you start looking nationwide and you go from cyclical markets to linear markets, by the way, let me explain that. There are 3 basic types of real estate markets: cyclical, linear, and hybrid. And cyclical, as the name would imply, is like a roller coaster. When you're looking at the graph of how that market performs over time, it's got glorious highs, it's got ugly lows, it's got peaks and troughs, peaks and valleys. And those are all the markets, Hunter, that make the news. They're the markets everybody pays attention to because they're newsworthy. A lot is happening. Anything on the west coast of the United States, from San Diego up to the Pacific Northwest in San Diego, cyclical market. South Florida, crazy cyclical market. The expensive northeastern markets, New York, Washington, Boston, those kinds of markets, cyclical markets. The rest of the country, though, is either linear or hybrid. Now, linear, as the name would imply, is when you look at that graph of how the market performs over time, it just kind of chugs along and will typically get anywhere from 3 to 6% average appreciation over time. The hybrid market is in between the two. Hybrid markets are places like Denver, Austin, and Phoenix. Those markets are not crazy cyclical, but they're not linear either. Memphis is a linear market. Indianapolis is a linear market. So hybrid, we touch hybrid markets. We love linear markets, and we completely avoid cyclical markets. So just kind of understand that idea. And this also applies worldwide. Dubai, what kind of market is that? It's a cyclical market. What kind is Hong Kong? Cyclical. Paris, London, cyclical. Okay. All the second and third tier places, though, those are either linear or hybrid. Most of the world is linear or hybrid, not cyclical. But the markets we hear about, they're cyclical. They're newsworthy.
Right. And you're seeing a lot of that for just a variety of reasons, particularly in places like Southern California, where there's a lot of flight capital coming in, just taking this inflation, price inflation to a completely different level. And then there's some areas where, you mentioned Phoenix, but also someplace like Vegas where there's not a lot of land constraints. Right. It also creates an extra element. I guess the new person to the party is kind of that Denver market, which is kind of really interesting. I mean, this most recent run up that they're experiencing is rather unique historically from that city. What are your thoughts on that market as a whole, given where prices are in residential and commercial in that market?
Yeah, well, I don't monitor commercial as much as you do. Okay, but just so you know where I'm coming from, I like housing. I own about 149, I think 149 apartment units myself with a client of mine. I've got a mobile home park, about 120 units, and then I own a bunch of single family homes. Okay. So I like housing. Office space is not something I'm interested in. Retail is going through the obvious apocalypse. I'm not saying there are opportunities in everything. Understand that. So even if I sound like I'm poo-pooing something, it doesn't mean you can't make money. Of course, you can make money in lots of things if you know what you're doing and you have the right network and connections. But and industrial properties, those are a whole different animal. Okay. So housing, because you can't outsource housing. You can outsource the call centers to India and the Philippines, lessening the need for office space. You can outsource the manufacturing to China and other inexpensive manufacturing destinations around the world. You can outsource retail to the internet. That's why we're having the retail apocalypse, as they call it. But you can't outsource housing. So as long as the population is either stable or growing, everybody needs a place to live. Now, obviously, it's not that simple. You talk about land constraints, and we should dive into that. But since you asked about Denver, Richard Florida wrote an interesting book about creative class cities. And Denver and Austin are considered creative class cities. These are cities where there are smart, upwardly mobile people, but they're not really expensive cities. I think we'd all agree that you can find smart, upwardly mobile people in Irvine, California, in Los Angeles, in San Francisco, and in Seattle, but those are already too expensive. Those cities, you couldn't make them work no matter what. They just don't work. And let me define what I mean by work. Work means, and this is my definition of an investment. For something to be considered an investment, it must produce income, period. If it doesn't produce income, it's a speculation or a gamble. Not to say you can't make money speculating and gambling. You can buy Bitcoin and Ethereum and vacant land and properties in Seattle and LA and San Francisco that don't make any sense. They won't produce income, but they might go up in value, right? The problem is can't predict the cycles. They're very unpredictable, number one. And number two, while you're waiting for the cycle, you can get destroyed, absolutely destroyed. And we've all seen that, right? Because the key to making income property work is staying power. And sensible properties that produce income provide staying power. So that's the key. We all agree that over time, real estate's going to go up, right? Just by inflation, if nothing else. But you got to be able to stay in the game long enough to make sure you're there for the good times.
Yeah, absolutely. And in fact, those big picture things about people saying, well, look, they're not making any more land. Well, everyone that's been in real estate knows someone that's lost an arm and a leg saying things like that, because it's all about timing and appropriate leverage and cash flow, like you said, and a variety of other things. Yeah, over the long term, yeah, sure. Well, if you can wait the long term.
Right. Well, I think it's maybe it's Warren Buffett who has the saying, the market can remain irrational a lot longer than you can remain solvent. Okay.
Exactly.
So, you may be saying, look, I know it's going to go up. I know it's going to go up. You can know everything, but the fact is the market's going to do what it's going to do. Mr. Market is very unforgiving. So you've got to engage in a practice I call sustainable investing. What makes investing sustainable is income, period.
Right. And yeah, I definitely want to talk about some of your thoughts on economics too, which we'll get into in a moment. But before we get into that, one of the things that I have I guess heard and also found challenging myself when it comes to single family is, I know that you have a tremendous amount of scale. How do you go about the management of having a tremendous amount of portfolios of single family houses all over the United States, from an on-site manager perspective, particularly?
That's what we do. That's the part that when I was simply trying to be an investor and not a business person, just for my own portfolio, that's the part I found so difficult. The management is where everything lives and dies. Okay. So you've got to have a good management team, or you've got to self-manage your properties, which amazingly you can do from a distance. I have self-managed properties I have never seen with tenants I've never met. And it works. You can make that work. The technologies available to us today are phenomenal. They really make that possible. So we teach people how to self-manage, but we also vet and recommend property managers. So our clients can do whatever they want. It's their choice. It's their property. They can do whatever they want. So the way you make the management work mostly, though, is by a buying power, the dangling the carrot of future is what makes the manager motivated to do a good job. Okay.
Yeah.
It's not perfect, but it works pretty darn well. And so when people buy through our network rather than doing it on their own, they have the buying power. So if they ever have a problem and they're sending an email back and forth with their manager, for example, and the manager's not doing things right, they just copy their investment counselor at my company. And when they see that, they know, look, some of these managers, literally half of their property management company is our customers. So they pay attention to that. Unless they're just stupid.
Yeah, I appreciate that. Yeah. I appreciate your explanation there, because that's actually something that's one of the main challenges a lot of people face with single family houses. If you're investing in properties, let's say in the $100,000 range, and the property manager stands to gain or lose a matter of $50 or $100 per month, it can be challenging, with that carrot and the stick thing, the differential between 50 or 100 or zero.
No big deal.
Exactly.
Yeah. But if you're 160 customers, which is the power we give you, you're going to be in good shape. Yeah.
Yeah. I totally appreciate that. So, in terms of the lending market, what is your perspective on where we are right now in the lending market, particularly as it pertains to single family?
Well, I think rates are going up. The Fed has stated, the Fed doesn't directly control mortgage rates, but they certainly influence it. We're going to see higher rates. I think that's pretty safe. It's been declared publicly many times that that's the direction we're going in. So, that's part of it. I think the banks have overcorrected with Dodd-Frank legislation and so forth, which is stupid. I hope Trump can just repeal it completely, but we'll see what happens with Dodd-Frank. And I haven't been keeping up on it lately, so something may have happened that I don't even know, but not that I've heard of lately. And uh, it's pretty hard to qualify for loans. It's too hard, actually. I think it was too easy before. Obviously, I mean, the loans they were making in the early 2000s were pathetic. They were stupid, obviously, and no wonder we had a crisis. Imagine that. But they have since overcorrected, and so there needs to be a balance. The pendulum needs to get into the middle where it should be. So that's what's happening there. But I want to make sure we talk about your comment about land values and then some of these other principles. The Hartman Risk Evaluator will tie in pretty well to your comment about Las Vegas and land constraints and so forth. Do you want to dive into that?
Yeah, absolutely. Let's jump into it.
Okay. So after 19 years, I made a discovery, and a phone call basically helped me make this discovery. I was buying one of my first out-of-state properties. I was sitting in my office in Irvine, California in 2004 when my insurance agent, Jennifer, called me. And I was insuring this property. And she said, Jason, we're going to give you $135,000 of insurance on this property. And those numbers were so foreign to me living in an expensive place like Orange County, California, okay, where, I would expect her to say, well, we're going to give you $1 million or $800,000 insurance on that property. Now, understand that the insurance company only insures the structure. They don't insure the land. Obviously, the house can burn down, but the land doesn't go away, so they don't insure the land. So when she told me, we're going to give you $135,000 of insurance, my brain just calculated the inverse of that math, meaning that I purchased the property for $159,000. So by deduction, the land value is $24,000. Now, at the same time, I had just purchased a home in an area called Turtle Ridge in Irvine, California. And that was a home to live in. And I remember my girlfriend at the time was kind of trying to talk me out of it. She thought I was overpaying for this house. She was wrong. We broke up, but whatever. But the interesting thing was this was a very premium property. It had a premium view lot, a big yard for Orange County standards, and it had a $90,000 lot premium just for the premium. The property was, I think, it was $815,000. Okay, and I created this idea called the LTI ratio. Everybody listening knows what the LTV ratio is, the loan to value ratio. Well, the LTI ratio is the land to improvement ratio. See, when you buy a property, you're not really buying one thing. You're buying two major components. One is the land, and one is the improvement, the house or the apartment complex sitting on the land. Okay? And when you do that, you really need to segregate the value of each of those components. So in this out-of-state property, I had $24,000 in land value for this little rental house and $135,000 in improvement value. This house I was buying for $815,000 at the same time had $659,000 in land value and $157,000 or whatever that math is in improvement value. It was like an 1,800 square foot brand new house. Okay. So do you see how different these two equations looked between the property in Georgia and the property in California, right? Obviously, California has much higher land values. Okay. So you follow me so far?
Yeah, absolutely.
Okay, good. So now let's fast forward a little bit. I live in this house that I bought for $815,000. I live in it for a year. Prices were escalating like crazy. Remember, it's 2004. Things are going nuts. Okay. The market is crazy. If any of your listeners were paying attention back then, it was obviously we were in bubble territory. So I called the bank and I said, hey, I want to refinance because what I wanted to do was pull the equity out and buy some more rental properties nationwide. And so they sent an appraiser over. His name was Eric. And there's an interesting story about the appraiser, Eric. I'll share if we have time. But the appraiser comes over and he says, "Congratulations, Mr. Hartman. Your property is now worth $1.3 million." And I thought, wow, I gained $485,000 in a year. Do I love real estate or what?
Right. And you're a genius.
Yeah. No, I'm not a genius. Everybody's a genius in a bull market. Okay.
Right.
That's the danger of, bubble markets and cyclical markets and cryptocurrencies and, the stock market right now and everything else, right? Everybody's a genius in a bull market. I got lucky. Okay. I didn't know that would happen, obviously. So then I refinanced, and then I can't remember right now what it was, but I think I had a second on that house, or there was a lower rate. Anyway, I called the same lender again a year later and said, "I'd like to refinance again." And he says, and the same guy, Eric, comes over. It was amazing that it's the same guy, right? Just fluke.
Right.
He comes back over and he says, "Well, I got bad news for you. Your house has gone down in value. It's now worth $1,235,000. So I lost, what's that, $65,000, right? In a year, right? So I lost some money on it, but I was up so much it really didn't matter. And then I asked myself the question. So when the land value goes up, or the overall property value, sorry, I gave it away there. When the property value goes from 815,000 to 1.3 million in a year, which of those two components go up? Is it the improvement sitting on the land, or is it the land? Well, I already gave it away. It's mostly the land value, right? Because you could still build that same house a year later for maybe a little bit more, but it wouldn't be $485,000 more to build an 1800.
Right. The labor is going to be inconsequentially more expensive.
I mean, it was more because the market was booming. Construction
Right.
materials were getting expensive. Labor was expensive because
We're talking 5 or 10%, maybe.
it's not hugely significant, right? So it's all in the land value. So then a year later, when Eric came back over again and told me I lost $65,000, what went down? Where did the decline in value come from, Hunter? It came from the land. Okay, the land went down in value. It still cost the same to build the house now 2 years later, right? So what I realized from this, and Jennifer's phone call to me about the Georgia property, is I coined the term the Hartman risk evaluator, because we can assess and mitigate risk on our investments if we simply invest in low land value markets and avoid high land value markets. Now, tie this into what I said earlier about the three types of markets: cyclical, linear, and hybrid. Which markets do you think have high land values?
Right. The cyclical markets, of course, are going to be much more subject to those changes.
Exactly. All cyclical markets have ridiculously high land values and very bad, in my book, LTI ratios, land to improvement ratios. The LTI ratio is good when most of the value is in the improvement, the house or the apartment building sitting on the land. So I coined the phrase packaged commodities investing, or assembled commodities investing. Now, that sounds like a weird phrase, right? Here's what it means. It means that, look, Hunter, I don't even really care that much about real estate, okay? It's just that when you stick the real estate label on an asset, you suddenly get all this favorable stuff. You get the most tax-favored asset class in America, and you get fantastic leverage and debt possibilities on that property because it's that asset class, real estate, is very well liked by lenders, better than any other. It's the most debt-friendly asset class in the world. Try to borrow money on your business, your gold coins, your Bitcoin, good luck. Okay? You want to borrow money on your real estate? They'll give you very good terms. See, real estate has been subsidized by the federal government since the Great Depression. through Fannie Mae and Freddie Mac. Okay. And it is a very special multi-dimensional asset class. And so when you slap the real estate label on it, that asset class becomes extremely favorable in many ways. But really, I don't even care that much about real estate. I'm more of a commodities investor because all of those ingredients that make up a house or an apartment building, lumber, concrete, copper wire, glass, steel, petroleum products, labor, all these things, right? All of those commodities are what I like to invest in. But if I went to the commodities exchange and bought them, I couldn't get 30-year fixed rate debt at 4.5%. I couldn't rent them out to somebody else and tell them to repay the debt for me and give me $200 extra each month. The government wouldn't give me any special tax incentives. But when you put the real estate label on it, it all changes and becomes magic. Okay. So when you talk about markets with a lot of land, like Houston's a good example. We've done hundreds of transactions in Houston over the years, and hundreds of transactions in Indianapolis, and many of these other linear markets we like a lot. Right? Houston has very liberal zoning laws, and it has ample land. Right? But the thing is, I don't much care about that. I'm really buying the construction materials. And if I can buy at or below the cost of construction and get the land thrown in for free and get cash flow every month and all those other multidimensional characteristics that income property offers, that's a great deal. I mean, you can't beat that with anything else. There's simply no other asset class that rivals income property.
Yep, I agree completely. And so just to clarify, there is so when you're focusing on Houston, are you seeing that the fact that the people are willing to give out building permits? I mean, how do you see that playing a role in the long-term strategy of a city like that, or Phoenix, or Las Vegas? I'm not sure how much exposure you have to those cities.
Phoenix is actually much more constrained, and so is Las Vegas too. And I live in Las Vegas, by the way. I'm not a fan. I'm not going to stay here, but okay. I have been living here for a year and a half. I just want to try living in some different places, Well,
that's definitely a different place.
well, Las Vegas is the closest no income tax place to live to California. And
right.
Having paid way too much money to the Socialist Republic of California over the years, I can't live in California anymore. It's against my religion. The government is just too messed up there. I just can't do it.
It makes sense. I mean, I think that's definitely a reasonable position to take.
So on my list of places I want to try living are all no income tax states: Florida, Texas, Tennessee, Nevada. Those are the places, because it's amazing. Taxes are the single largest expense any of us will have in our lives. We had better pay attention to it. We had better learn how to use the tax code to our advantage. And income property just so happens to be, of course, the most tax favored asset class in America.
Yep. And it's obviously not the case in all countries. It's not as advantageous in certain countries.
Oh, no.
And so we're very, very lucky to be able to experience that.
You are absolutely right. The U.S. has an incredibly unique and special real estate market. Absolutely. I've never found anything international that really works.
Yeah, totally.
Yeah. I've been to 81 countries. I've looked. Yeah.
Let's talk briefly about the overall market cycle. Where are you seeing us right now? You mentioned earlier it's challenging to get loans in single family. Where do you see us being in the big picture market cycle in the real estate market?
Well, here's the problem with trying to answer that question. Which market? In a country as large and diverse as the United States, there are 400 real estate markets. And this 100, I'm sure it drives you nuts too. I'll be listening to someone on TV or reading an article, and they'll talk about the quote housing market, unquote, or the real estate market. What does that mean? I mean, is it LA, Miami, Indianapolis, Memphis, Atlanta? I don't know what that means. You have to at least divide them into the three categories: linear, cyclical, and hybrid. Now, if you look at the Case-Shiller index, I mean, that will just guide you so poorly. It's really it's really a shame that people use something like the Case-Shiller index because it profiles, I mean, the main Case-Shiller index, the one that's quoted all the time, 20 markets. And guess what? If you look at the list of the 20 markets on the Case-Shiller index, 2/3, well, really 3/4 of them are cyclical markets. They're markets I wouldn't touch, I wouldn't care about. Only 5 or 6 of them would be markets that would interest me because I'm just not a speculative investor. Okay. So,
Yeah, that's fair.
yeah, yeah. So, so in the cyclical markets, I think they're overvalued bubbles waiting to pop. That's my answer. In the linear markets, I think they're still very healthy.
Okay, got it. That's fair. And I've seen a lot of similar metrics. They're looking at a couple of cities where I just wouldn't be involved no matter what the proposed discount to market is, just because you just don't know where the bottom is. It's really challenging.
You know, and it's funny, this talk, there's this like disease that goes on in the minds of investors. We all have it, we all think about it, and we all try to time the market. And we say things like, well, I'm going to save up my cash because when the bubble pops, I'm going to go in and buy everything. Well, the problem is you never know where you are in the bubble, right? You might think, oh, well, we're at the bottom. And we're not. There's a lot more to go down, right? Or you might think we're at the peak and we're not. There's more to go up. It's just incredibly hard to predict this stuff. Look, if it was easy to predict, don't you think the chair of the Federal Reserve would know?
Right.
I mean, they don't know. Okay, Trump doesn't know. Janet Yellen doesn't know. The new Fed chair doesn't know. Alan Greenspan sure as hell didn't know. Neither did Bernanke. Okay, these people have way more information and obviously more control than we do, and they can't figure it out. You think we're going to do it?
Yeah. No, yeah, that's a good point. I mean, the infrastructure and the resources and the amount of data that they have, it would be pretty challenging. Yeah. Having said that, I think, and I tend to agree with you in that then they don't know, but there are, a lot of people out there that think that maybe they do know and that everything is really just posturing. It's basically just, advertisement in the same way that.
Okay. So there's something to be said for that. Yeah, no, I got you. So, there was an article, and I think it was actually in Rolling Stone, of all places, years ago, and it became quite famous. You might have read it or be familiar with it, where it talked about Goldman Sachs, the giant bubble machine, okay, and how these bubbles, if you want to get conspiratorial, are actually engineered, right? And because the big powers will inflate the bubble, extend tons of credit, and then deflate the bubble by contracting the credit supply. People will start losing their homes, go into foreclosure, their credit will be destroyed, and then they buy all the assets when they're cheap and then do it over again and reinflate the bubble. And by the time those people with the destroyed credit who lost their home, their car, didn't pay their student loan, whatever kind of debt it is, are trying to cycle back into the marketplace, they're told they have to pay higher rates for financing of any kind. And so they make money off all of these steps in the way, the powers that be. I mean, there's something to be said for that conspiracy theory.
Yeah, it's interesting. Yeah. I mean, I guess, kind of to tie it in with that previous conversation, you mentioned, in 2005, we were in such clearly bubble territory, particularly in California. It's fascinating to me that, Jason Hartman can figure that out pretty much on his own, as opposed to, Ben Bernanke. But I really think it's a result. And again, there's disagreements about this, but I think this is a result of the incentive alignment in terms of the Fed. I think that they are actually, as their vision is so clouded by what their jobs and how their incentives are lined up, and how virtually every politician is completely aligned to completely inflate prices indefinitely. Mm-hmm. We did a great interview with, it's called Political Incentives. It's episode 11. And take a listen to that for any listeners out there that want to continue that conversation. I do have a couple more questions I want to ask you before we close up the time, because I want to be respectful of that. Kind of, just kind of rapid fire here. You mentioned cryptocurrencies a couple of times. I know you're interested. You have friends that are certainly interested in the space. Briefly, what are your thoughts on, the cryptocurrencies and the blockchain technology as a whole?
I, first of all, would love to be wrong about what I'm about to say, but I'm not a believer. And I'll tell you why. Well, I'm not a believer from the perspective of most people, what's being talked about and what's being done out there, because Bitcoin has 21 million coins, and so all the fiat money people and the gold bug type mentality people are out there saying, well, the dollar's not backed by anything, neither is the euro or the yen or whatever, right? Yeah, you're right. So what? Okay, you're right in concept, but the gold bugs have been wrong for a long, long time. Okay.
Hmm.
And the same mentality goes on in cryptocurrencies. Uh, Look at the major product of any government and their cozy relationship with the central bank, whether it be the Fed or the ECB or whatever central bank, is their product, the widget they produce, the business they're in, is producing currency. And guess what? For all the people that say the dollar's not backed by anything, have you ever seen an aircraft carrier or a intercontinental ballistic missile or a tank or a fighter jet? The dollar is definitely backed by
Yeah, that's
okay.
good for sure.
You're like, people that say that they're just idiots. Okay, it's just a dumb thing to say.
Yeah, it's
Okay,
backed by the army.
yeah, these are the most powerful entities the human race has ever known. They have standing armies, and they are going to protect their major product, which is currency. Do you think they're going to stand by and let some decentralized currency displace the dollar?
Oh, just ask Libya.
Yeah, yeah,
Just ask
yeah.
Libya if
Ask
the dollar's
Saddam.
backed by anything. Yeah,
Yeah. I
exactly.
mean, ask Iran. Like Iran and North Korea, they don't participate in the central banking cartel. So guess what? We don't like them mysteriously. Uh,
Right.
I mean, it's just dumb. Okay,
Sure.
but I'd love to be wrong about it.
Fair.
I'd love to be wrong. I'd love to be wrong about this because as a libertarian, okay, I would love nothing more than to see the banking cartel, the crooked, corrupt banking cartel, get some competition from a cryptocurrency. Sure. But the fact is, they can squash those things anytime they want to. And I know I can hear all of you out there now, but Jason, it's decentralized. They can't control it. You want to bet? They're doing a decent job controlling cocaine. That's a commodity. People trade in it. Okay. Did you see Scarface? I did. Okay. I mean, yes, it's still good. It could still be out there on the black market, but it will have almost no impact if they decide to squash these cryptocurrencies. Um, the cryptocurrency that's going to win the game is the one that the central banks and governments create eventually, right? The technology is really cool. I love that. There are all sorts of applications for blockchain that will change the world. I agree with that. But blockchain is not Bitcoin, and Bitcoin is not blockchain. Okay. They're two separate things. Just because one uses the other doesn't mean it's a good investment. Okay. So that's one thing to consider. There are all kinds of utilities for these tokens and coins. I mean, there are great applications for this stuff. I just am bugged by the people that are borrowing money on their home equity loans or their credit cards to go and buy Bitcoin. They are going to get crushed, if you ask me. I just be careful, okay? And again, I'd love to be wrong about all this. Okay. So,
Fair. Okay. Yeah. Just real quick, and this is not something we've discussed too much on the program before, but I know that you have had guests on your program in the past talk about the whole life insurance policy
yep.
and kind of compounding that with real estate. Do you implement this? Is this something that you have seen used successfully? What are your thoughts on the whole life? Basically infinite banking, as that's called.
Yeah. So I don't think it's like a panacea. I don't think it's the greatest deal in the world or anything. I do like it though, because it's got asset protection components that are good. I really like that. It's got this store of money type of utility to it. And once that money's in that policy for a while, it's pretty well shielded from creditors, is my understanding, in case you should ever have a problem. And so that's fantastic. I love that component about it. Um, is it as good as buying a bunch of rental properties? No, but it also, if it's designed properly, can be combined with rental properties very well. Where
Right. That's really the strategy I was kind of
right,
referring to, just
yeah,
as
no,
it,
I know.
borrowing against that.
Yeah. So you can put, say, $100,000 into one of these policies, but you got to have the right people design it. Okay, there, to say a policy is like saying a property, right? Well, which property? Well, which
Hmm.
policy? What,
Hmm.
I mean, there's a million flavors here. So you got to have a good person helping you with it. I mean, I've worked with Paradigm Life a lot. I like those guys. They're great. So you just got to have a good person designing it for you. Okay. And if you do, you can borrow almost all of that money out of the policy if it's designed properly right away, leaving like maybe 15% in the policy. And then over the course of time, as the policy grows, it's kind of a forced savings program, which is not terrible, okay? Just because we all know human nature is to spend what you have, which is an unfortunate thing. And so it does provide some good discipline for you in that way as well. So yeah, I think it's pretty good. You just got to do it right, like anything.
Certainly. And the complexities of those plans,
They're complex. Yeah.
it really is something you need to take a close look at.
I agree. I agree. I don't like complexity. I always say if an investment's not simple, then, you better be careful. You better really learn. So, have good people and learn about it yourself.
So, quick question about your podcast. You've obviously interviewed some really fascinating, really intelligent, really interesting people. What is the number one person that you interviewed that really, either the interview itself, made an impact on your life, or, before or after that interview, what is the most influential person you've interviewed on that program?
Well, I think Ron Paul would be my favorite. Not that his interview was the best interview I ever did, but I thought, I like Ron Paul. I like his philosophies. I think he's kind of unrealistic though about it. But hey, someone's got to be saying this is the moonshot idea, and let's get closer to it. So I think that's reasonable. We actually hired him to speak at our last conference. We do an annual conference called Meet the Masters of Income Property. So I had him on the podcast before that. And I've got almost 1,000 episodes now of my main podcast called The Creating Wealth Show. And so I've had some great guests. I mean, Steve Forbes was really good. Um, Lots of financial gurus have been on, many times. I've had Harry Dent on the show like 7 times now. Although I don't know, Harry Dent his predictions are getting a little off. Hey, look, I don't know. I like to just explore and learn from people.
Sure,
and,
the data is important, right?
Put it all in
the
your
prediction.
brain, try and figure it out. Yeah.
Yeah. Okay, awesome. Well, one last question. I think that this is one I always like to end with. If you had one piece of advice for young real estate entrepreneurs out there that really the goal would be to just streamline their career, avoid some of the fluff, what would that advice be?
Well, obviously get education, but don't spend a lot of money on it. You don't need to. Okay. You don't need to spend a lot of money. You don't need to join someone's $50,000 coaching program. Okay. A lot of this information is either free or cheap. Podcasts like yours, podcasts like mine, you can learn a lot of this stuff with very little money. So education is obviously important, and from there, find the people you trust, the people that make sense, and build your team and affiliate with them. If you're looking at the single family home world, which is mostly what we do, hey, check out my podcast and check out our team. We'll help you with it. If you're looking at something bigger in terms of, what you do, then, look to you for guidance there. And that's the most important thing. But don't be the educated derelict. Don't be the person who's learning stuff for 20 years and never doing anything. That's another kind of mistake. Education is good, but the real education will come from doing things.
Awesome. Well, Jason, again, I really appreciate you coming on, and we will provide links to those assets you just mentioned in the show notes page. So I really appreciate it. Thanks again.
Yeah, my pleasure, Hunter. Thank you. And my website's jasonhartman.com, and happy investing to you and your listeners.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.